All right, everyone. Well, thank you for joining this webinar with Bitflyer US and CoinTracker.io. We know that we are in the throes of tax season, and I myself, my name is Al. I'm here at Bitflyer US. I've been in crypto since about 2013, 2014, and I know that taxes are truly dreadful. And so we brought my friend Shehan here to come to teach you how to lower your exposure to the IRS and deal with assets or taxation dealing with cryptocurrencies. As Forbes will call him, Shehan is one of the handful of CPAs in the country who's like a real operator and like a subject matter expert on cryptocurrency taxation. Is also highlighted in Accounting Today as one of the few people that is going to reshape the future of accounting itself. And I can go on and on and on about Shehan, but I'm not going to blow up his ego like this. So I'll go ahead and introduce him or pass it over to him, and we can get started.
Yeah, thanks, Al. Let me share my screen with you guys right now. Yeah, today we're going to talk about crypto taxes and basically, how to get out of the IRS trouble. And hopefully you guys can see my screen and hear me clearly. So just to give you a quick intro, my name is Shehan. I'm the head of tax strategy at CoinTracker. It's pretty easy to find me online. Just go to Twitter and at the Crypto CPA. I answer a ton of questions every day. So if you guys ever have any questions, even after this presentation, feel free to reach out to me. Just a quick, objectives. These are the three things that we're going to cover today. First, we're going to give you a quick overview of crypto taxes. This is a great time to know about crypto taxes because we're in the middle of the tax season. And secondly, we're going to go over some tax saving opportunities. And finally, we're going to show you how software can help you resolve your crypto tax issues and kind of give you peace of mind. Just to give you a quick disclaimer, tax laws are extremely complicated. This is just for educational purposes only. If you have a specific situation, I highly encourage you reaching out to your own tax practitioner so they can understand your specific situation and give you guidance that's appropriate for you. So this chart kind of gives you a quick idea of where we are today in terms of accounting and tax compliance side of things. I'm not going to go through all these milestones. I'm pretty sure if you guys are in crypto, you guys are already aware of at least the gray side of this timeline. But 2014 was important because that's when the IRS first came into the picture and said cryptocurrencies are treated as property. And after that, they came up with several other guidance, FAQs in 2019. And in the meantime, around 2018 and 2019, they sent out these 10,000 tax notices for people. And then the latest thing is this inclusion of the virtual currency question on the page one of the Form 1040. This community has mixed feelings about including this question on page one of the Form 1040. In my opinion, I think it's good. Actually, in my opinion, IRS is advertising crypto to roughly 150 million taxpayers, free of charge. But I can also understand that, the scope of this question is super, big. It's pretty much asking if you receive, sold, sent, exchange, or had any financial interest in virtual currency. And if you are in this space, it's really hard for you to say no for this question. Because if you're staking or if you're taking a crypto loan or if you're just trading, that would trigger you to say check. That would trigger you to say yes for this question. So yeah, number one is just make sure you understand this question correctly. Make sure you answer this question correctly, and also know that just because you say yes doesn't mean that you're going to get audited tomorrow. The purpose of IRS setting this question is to gather information about U.S. people with crypto affiliation. Their purpose is not to come after you and audit you and penalize you for not reporting things correctly. But at the same time, if you have crypto and if you fall on any of these categories, don't say no fraudulently because that's not good for you. So yeah, this is probably the main highlight. It's quite remarkable for me to see this because several years ago, this was somewhat of a niche subject when it comes to IRS. But starting 2020, IRS actually cares about this so much. They even include this question about the number of, dependents, about, the question that they ask about the number of dependents you have. So that's how much they care about this question and the virtual currency in general. Okay, so taxation. So if you talk about taxation, there have been 3 guidance. This notice 2014-21, 46 FAQs, which are still on the IRS website. By the way, we'll share the link to this slide deck, so you can click these links to get more in-depth information about it. And then lastly, the revenue ruling 2019-24. So the idea here is that when it comes to taxes, for those of you who are new to this space, cryptocurrencies are treated as property. What I mean by that is the tax treatment is very similar to stocks and securities. So you have a purchase price, you have a sales price. If you make a profit, that profit is subject to capital gain taxes. So that's a very easy way for you to kind of comprehend crypto taxes. Now, speaking of taxes, I think the next natural question is, when do you owe crypto taxes? So here's a very simple way to kind of remember when you owe crypto taxes. So these are the primary 5 situations. So let's go through each one of these. So number 1 is when you sell a cryptocurrency into fiat, which is self-explanatory. Say that you got a Bitcoin for $1,000 and you sold it for 50,000, you would owe capital gain taxes on 49,000. That's pretty easy to understand. And the second one is, still there are a lot of people who don't really understand this. This is a situation where you go from one cryptocurrency to another. Let's say you have Ethereum and you're using Ethereum to buy Bitcoin or some other cryptocurrency. That also creates a taxable event. IRS doesn't really care whether you receive cash or not. As long as you make a profit from going from one coin to another, you got to pay taxes on that. And then number 3 is when you spend cryptocurrency to buy products. Say that you have 1 Bitcoin and you're buying a Tesla or even a cup of coffee. That creates a capital gain tax event because cryptocurrencies are treated as a property in the US as opposed to a currency. Number 4, you have a taxable event when you earn crypto. So you earn crypto through, it could be wages. You might be working for a startup and getting paid in crypto. That's a taxable event. Your staking income, mining income, interest income, those are taxed at the time you receive that cryptocurrency. Just remember that. And then lastly, these are like, somewhat technical, are a couple of situations where you would have a tax liability. Number 1 is when you get like an airdrop. Like last year, we saw 2 significant airdrops, Uni airdrop, Flare airdrop. So at the time those tokens hit your wallet, that creates a taxable event. And then, of course, like a hard fork in 2017, the Bitcoin went through a hard fork, and everybody who had Bitcoin got Bitcoin Cash, and that's a taxable event that you should have reported to the IRS. So just remember these 5 situations. If you come across any of these situations, so most likely you will have to file a tax form, and you will have a tax obligation if you make a profit. Now, the next question is, we spoke about the 5 situations that you would owe some taxes. And the next question is, what kind of taxes? So in the US, there are 2 types of taxes, generally speaking. One is, ordinary income taxes. People, call it just income taxes. So your W-2 wages. If you work with somebody, you pay income taxes based on your tax bracket, as you can see on the left side of the slide. Now, if you have mining income, staking income, or crypto interest income, or airdrops and hard forks, these are subject to your income tax bracket. So these are pretty much taxed as your W-2 income. And also, if you trade crypto, after holding it for less than 12 months, we call it short-term capital gains. Those gains are also subject to this, regular income tax brackets. Now, if you move to the right-hand side of the slide, when you trade crypto after holding it for more than 12 months, we call them, long-term capital gains. And those long-term capital gains are subject to better rates compared to your regular income taxes. For example, the highest long-term capital gain tax rate, as you can see here, for unmarried, single person is 20%. But the highest regular income tax percentage for unmarried person is 37%. So there's a huge difference. So the TLDR here is that if you really have to sell something, just make sure you sell your crypto after holding it for more than 12 months, because that gives you a huge discount in taxes. Now, The next question, this is very natural in the crypto community because crypto is, based on this whole premise of anonymity, doesn't have a central authority and etc. So they're like, how does the IRS know if you have any crypto, affiliation? So these are the 4 ways that the IRS knows you have some type of crypto currency transactions. So number 1 is through 1099-Ks and 1099-B forms. If you go to exchanges and if you go to their tax center and if you see any of these tax forms, that means that information has already been reported by the exchange to the IRS. And when you file a return and if you don't report these tax forms correctly on your tax return, 99.9% of the time, IRS is going to send you a letter asking your explanation why you didn't report it, and then you would have to report them correctly, and you might even have to pay penalties for not reporting it around time. So yeah, I mean, if you see any of these tax forms appearing on any of the exchanges that you're dealing with or a wallet, you got to report it because IRS already know that you have crypto transactions. And then number 2 is through subpoenas. Several years ago, Coinbase got subpoenaed, and as a result, they had to release their user information, including the names, addresses, and social security numbers. So IRS knows some of the information through those mechanisms as well. And third is through the Form 1040 crypto question. That's a question that you're required to answer. And if you did have any trades, and if you say no, that's considered that's not good because you're signing the return under penalty and perjury. So by putting that question, you have to give the IRS that information about your cryptocurrency affiliation. And then lastly, IRS knows about your crypto transactions through these blockchain analytics tools like chain analysis, cipher and etc. So yeah, just know these are the 4 ways that the IRS knows about cryptocurrency. Just because cryptocurrency is considered to be anonymous or pseudo-anonymous in the case of Bitcoin, it doesn't necessarily mean that IRS is completely invisible from what you are doing in this space. Okay. Yeah.
Real quick, back about the short-term taxes. So does exchanging like one crypto for another in less than a year make that transaction liable for short-term taxes?
That is correct. Yep.
Okay. Thank you.
Okay, great. Yeah, so IRS crackdowns are, I'm pretty sure you guys saw this news. This is probably the latest news that came from the IRS. Recently, IRS deployed this thing called the Operation Hidden Treasure. Do you guys hear me? Do you guys hear me twice, or it's?
You're breaking up a little bit, but
Is it better now? Okay. Let me rewind for a couple of minutes. Not a couple of minutes, 20 seconds. Yeah. So the IRS deployed this new program called Operation Hidden Treasure. So this is a program that they're doing in conjunction with their civil and criminal departments. So they're training a lot of agents to catch cryptocurrency tax evaders and criminals who are using cryptocurrencies to evade taxes and and do illicit activities. So just make sure that you get your taxes right, because this is not the greatest. This is not the best time to even not report anything, because IRS has these mechanisms in place. And generally speaking, cryptocurrency is probably the worst asset class to evade taxes, because there's a permanent record about your transactions on the blockchain, unlike cash transactions with no record. So okay, let's talk about getting paid in crypto, because this is also common in this space. The TLDR here is that is also common in this space. If you're getting paid in cryptocurrency, you had to report it as regular income. Sometimes you get W-2s and sometimes you don't. And then you had to recognize the order income equivalent to the market value at the time you receive it. And you just have to also make sure that you withhold, federal and state income taxes if you're getting paid in cryptocurrencies, and also just make sure that you keep the records for at least 7 years, and it's really important. So I briefly mentioned on that timeline about the IRS tax letters that were being sent out in 2019 and 2020. So these are the 3 tax letters that that went out to people, and hopefully you will not ever get these letters. But in case you're curious, how these letters look like, these are linked. So these letters came out in 3 variations, that is 6173, 6174, and 6174-A. Again, here, if you get these letters, and it's highly likely you're going to get it, not necessarily because you did something wrong, it's because of how the IRS system, works with the current information reporting system, in the crypto world. Just don't panic. Usually, if you see one of these letters, it's going to say, okay, you owe, this much of taxes, and we need a response by, within 30 days or something like that. So in case if you receive some of these letters, just make sure you keep this slide handy. If you click the link IRS Crypto Tax Letter Guide, it's a free guide that you can use to respond to the IRS. It has a free template letter that you can use, which has worked for a bunch of our clients as well. So, and it tells you what to write. It tells you what needs to be attached, because when you get these letters, there's a certain way that you need to respond to the IRS, and understand where they're coming from, and you need to explain it correctly to the IRS. So I thought I would include this. This was a situation where this college kid, did some transactions in the crypto space, and I think after several years, IRS sent him a bill saying that you owe $300,000, and as a matter of fact, he didn't make any money. He was going from one coin to another, but the exchange kind of miscalculated things and reported that to the IRS. Anyway, he was able to use our guides and use the CoinTracker reports to kind of mitigate that, and he ended up paying nothing. So yeah, I mean, when you first get those letters, you're gonna get panicked. My message for you is don't panic. Just use the resources that I showed you earlier. Okay, this is another important concept to know. I mean, if you ask me what's the most important slide in this entire deck, I would point you to this. So the statute of limitation is this concept that gives the IRS the power to come and audit you. You just have to remember that just because it's IRS doesn't mean that they have all the rights and privileges to come and audit you. Even they're restricted legally by other laws that have been set by the Congress and etc. So here, what you need to know is that if you correctly file your tax return, IRS only has 3 years from the date that you file the return to come and audit you. And after that 3 years, IRS does not have a legal right to come and audit you unless you underreported your income by 25% or more. In that case, IRS can come after you even after 6 years, within the 6-year period, because you underreported your income by more than 25%. Now, the bad part is that in the crypto community, I hear this all the time. They're like, okay, IRS doesn't know my crypto transaction. They don't need to know, so I'm not going to file any crypto taxes. But this is really bad for you, because if you don't file a tax return, you don't start the statute of limitation. And what you're doing is you're giving the IRS unlimited time to come and audit you. So essentially, if you're not filing your crypto taxes today, IRS could come after you at your retirement, or 2040 or 2050, because you never started the statute of limitation and start that 3-year limited time period that the IRS has legally. So this is why filing something is better than filing nothing, because when you file something, you start the statute of limitation, and from that date, IRS only has 3 years to come and audit you. So my message here is that just give the IRS the least amount of time, which is 3 years, to come and audit you, because after 3 years, you're protected. Okay, so in this section, I'm going to talk about tax saving strategies. And this is pretty much how we can save a bunch of money if you have crypto, by thinking smartly about tax laws and applying some of those strategies. Yeah, so when you speak about tax saving strategies, they fall under 3 categories. Number one, some of them allow you to completely eliminate taxes, which is great. Some of them allow you to reduce taxes, and some of them allow you to defer taxes, meaning you get to pay the tax bill in a later year where your income tax bracket is lower than today. So these are 3 ways you can save on taxes. So now we'll go into some of those actual strategies that you can use to achieve those 3 things. Number one, this is something that a lot of people actually don't know about. there's a 0% long-term capital gain tax rate in the US. If you meet certain income thresholds, as you can see on the right-hand side of the slide, like say for example, you're married and you have long-term capital gains of 80,000, and that's actually going to get taxed at 0%. So essentially, if you're married, you can cash out up to $80,000 worth of long-term capital gains every year and pay absolutely zero taxes. And if you're single, that limitation, that threshold goes down to 40,000. And again, you still have to file a return to kind of show that you cashed out long-term capital gains of either 40,000 or 80,000, but you end up paying no taxes because the long-term capital gains have zero taxes if you meet these criteria. The other thing that you can do is tax loss harvesting. As you know, crypto world, it's got a lot of fluctuations, goes through bear market and a huge spikes in prices and etc. So whenever your cost basis, meaning how much you paid for the coin, is higher than the market value of the coin, what you can essentially do is you can sell that coin and harvest that loss and quickly get back into the same position. And when you sell that coin at a loss, you get to harvest that tax loss, and that tax loss can reduce your crypto capital gains, your stock capital gains, and in some cases your regular W-2 and business income as well. So and then tax loss harvesting is something that you should kind of think about doing like every quarter. So sit down with a CPA, or you can use a tool like CoinTracker and see where your portfolios are. I'm pretty sure if you have multiple coins, some of those coins are in the red, and some of those coins are they're doing good. If something is below the market value is below how much you paid for it, tax loss harvesting is something that you should definitely do, because that's going to give you a big relief when it comes to paying your tax bill. And then the other thing that you can do is picking a smart accounting method to calculate your capital gains. There are multiple accounting methods. FIFO stands for first in, first out. LIFO stands for last in, first out. HIFO stands for highest in, first out. So these accounting methods pretty much tell the IRS which specific unit of coin that you're selling for tax purposes. And ideally, what you want to do is for tax purposes, you want to be selling the coin which you paid the highest amount for. When you do that, the difference between the sales price and the cost basis is much lower, and that leads to the least amount of taxable gain. And if you use a tool like CoinTracker, you can easily change between these accounting methods, and actually you can see the impact on your tax bill when you're using FIFO versus LIFO versus HIFO. And here, if you click the link, more information, I did like an in-depth blog on how these accounting methods impact your tax bill. So generally speaking, just make sure you use HIFO, highest in, first out. That way you're selling the units with the highest cost basis for tax purposes. Donating crypto is another way to reduce your tax bill. And donating crypto is one of those few situations in the code that lets you have two benefits at once. So when you donate your appreciated cryptocurrency, number one, you don't have to pay capital gains taxes on that cryptocurrency, and number two is you get a deduction which reduces your crypto income and also like non-crypto income, like W-2 businesses and etc. Like here's an example, like just to give you an example, say that you got a Bitcoin for $1,000 and now it's worth 50,000. What you can do is you can directly contribute that Bitcoin to a charity. And when you do that, you don't have to pay capital gain taxes on that $49,000 because it's a donation. And number two, you're going to get a deduction for $50,000 on your tax return, and that $50,000 could reduce your stock income, W-2 and etc. So something to think about. And moving on to the next point, also know that gas fees have tax benefits if you classify them correctly. This has been an issue for a lot of people that's in the ERC-20 environment. Typically gas fees go up when the networks get congested. And if you treat them correctly, you can add it to the basis. Sometimes even you could get a deduction. So if you're using a crypto tax tool like CoinTracker, we handle gas fees correctly. and you're getting a tax benefit gas by spending money on gas fees. So just don't think that it's just a waste of money and nothing happened. I mean, true, it's a waste of money if you don't classify them correctly, because that way you're not capturing any tax benefit out of that expense. Another thing that a lot of people are doing these days is trading cryptocurrency in a self-directed IRA. So this is especially set up custodial account. You can Google self-directed crypto IRA. Essentially, you set up this special IRA account with the custodian, and then you do your crypto trading, staking, or whatever inside the account, and the gains are tax sheltered until your retirement. So this is a great way for you to save for your retirement and not not having to pay taxes today on the gains. Moving on to the right side, if you're doing mining operations, specifically proof of work mining, which requires a lot of equipment and etc. There are so many provisions in the IRS tax code that allow you to deduct these equipment or specifically speaking graphics card expense. Like for example, Section 179, it allows you to deduct up to $1 million worth of equipment, and then the bonus depreciation you get to deduct 100%, like unlimited amount. So just make sure you structure this correctly. Talk to an accountant, because if you're running a mining operation, essentially you're not paying any taxes because you're getting so much depreciation out of those equipment, which reduces your taxable income to virtually zero. So these two strategies are somewhat advanced. Again, this is not for everybody, but just know that there are these strategies. Opportunity zone, this is specifically suited for these very, very high net worth individuals. For example, say that you got into Bitcoin like so early, let's say in 2010, 2011. Let's say you invested $1,000 and now you have, I don't know the numbers, but let's say you have $10 million worth of portfolio. So in this case, what you can do is you can sell that portfolio and contribute that money to these opportunity zones. And then if you were to keep your money in the opportunity zone fund for 5 years, you get a 10% discount on your capital gain taxes. And if you were to keep it for extra another 2 years, you get another 5% discount. And if you were to keep it for 10 years, you're gonna get to eliminate the capital gain taxes on the underlying, qualified opportunity fund stocks. Again, these are very, very advanced strategies. I just gave you like a very high level overview. In case you're curious, we can click the link and it will show you everything. So something to think about. And then finally, the tax status is important. Some crypto exchanges, they have these, derivatives called Section 1256. As you can remember, like in order for you to get the long-term, better capital gain tax rates, typically you had to keep your coin for more than 12 months. However, if you're dealing with Section 1256 futures contract, you get that long-term capital gain treatment for 60% of the gain, even if you don't hold that contract for 12 months. So, and if you're doing so much of trading using these contracts, that's going to add up to a big amount of tax savings. Okay, so we'll have like half an hour or so for the questions. Before we go into the questions, I just want to kind of give you a quick recap on what we discussed so far. So we discussed first, I think the number one thing to know is that crypto is taxed, and I guess a lot of people are still not aware of that fact. There are 5 situations where you got to pay taxes. Number 1, when you cash out your crypto. Number 2, when you trade one cryptocurrency with another. Number 3 is when you earn cryptocurrency. Number 4 is when you spend cryptocurrency to buy day-to-day stuff. And number 5 is when you have like an airdrop or a hard fork. So those are the 5 situations. And we also spoke about how the IRS knows about cryptocurrency affiliations that you have. And then we spoke about different types of taxes, capital gains and capital losses. And finally, we spoke about some of the tax saving strategies. And CoinTracker is pretty much a tool that helps you, calculate your capital gains taxes, and also allows you to do tax saving strategies like, tax loss harvesting, etc. So essentially, it's really hard for you to, if you have multiple coins and multiple exchanges, it's really hard for you to figure out how much you paid for each coin, how much you sold that each coin for. And then, you had to have all the records of your, dates, and you had to make sure you're using the right accounting method, FIFO, LIFO versus HIFO. It's really hard to do this manually, and in most cases, virtually impossible. That's where a tool like CoinTracker could come in handy. So all we had to do is connect to exchanges. Like we have a direct integration with the Bitflyer as well. So essentially, in the case of Bitflyer, you would just drag and drop the transaction history report to CoinTracker, and then we figure out your capital gains. We sort out everything for you. So that's pretty much what CoinTracker does. And most taxpayers, if you have coins spread across multiple exchanges and wallets, it's virtually impossible for you to calculate these capital gains and losses unless you use a tool like CoinTracker. These are some additional resources for you. If you're an attendee of this presentation, and if you sign up for a CoinTracker subscription using this link, you're going to get a 10% discount. And also, if you have any further questions about the tool, you can also use the Contact Us link. And finally, the takeaways here are threefold. Number one, crypto tax, capital gains, it's new. IRS is cracking down on it. Make sure you use like a well-recognized software. So in case something happens to you in the future, you can prove to the IRS that you took all the reasonable measures to calculate your capital gain taxes correctly. And using a tool like CoinTracker would help, make that case stronger. And number two, a lot of people think that, okay, paying taxes sucks. Yes, it sucks, but just know that there are ways that you can legally reduce your tax bill. Think about the things that I discussed earlier that allowed you to eliminate, reduce, and defer taxes. Make sure you sit down with a CPA throughout the year, not when you file the tax return. You got to do this inside the year if you want to have an impact for your tax bill. So keep those strategies in mind. And last but not least, file something to start the statute of limitation, because if you don't file any return or crypto tax return, you essentially give IRS unlimited time to come and audit you. And don't do that. Just file a return. And then that limits the IRS's ability to come and audit you for 3 years, which is very short. With that, Al, I think we can go to Q&A.
Well, can you hear me, Shayan?
Yeah, I can hear you.
Okay, great. Sorry for our issues earlier. I think my computer camera was taxing this event, so you can't see my face anymore, but whatever. So I have a quick question. I mean, we'll definitely make these slides available for everyone that's on our email list, and of course the team at Bitflyer. But so feel free to drop your questions in the Q&A. So I do have a quick question. So it's about the airdrop taxation, right? So you know how sometimes when new companies come out in crypto, they'll take a snapshot of like the Ethereum mainnet or whatever, and just like airdrop wallet addresses. Just like you'll just wake up and you're like, why do I have like 1,000 of these random tokens?
Yeah.
Right? Fuel their like marketing expenses and stuff, or marketing exposure. And so you're saying that those random airdrops that you just didn't even want to participate in are like liable for those?
I know I totally get because I know how things work in the crypto community, but I don't think IRS is fully aware of things. To answer your question, unfortunately, even if you didn't ask for it, it's a taxable event because you got a coin. So that's a short answer to your question.
So then,
Then
sorry. So the second part of the question is then. So let's say you have 1,000 OMG tokens or whatever from some airdrop. Your tax on event, and then they sit in your exchange for because you don't notice them, and you sit there. They're like, oh, let me sell these, and then is that another taxable event on top of it?
Yeah. So you pay taxes at the time it hits your wallet, based on the value of the coin at the time it hits your wallet, and say that you're later selling it for for a higher price. So you would pay capital gain taxes based on the difference between the sales price and the value of the coin at the time it hit your wallet.
Okay, so I will literally not use a single company that is sending me airdrops for no reason.
By the way, this is a huge problem, by the way, I think the good thing about CoinTracker is that some of these airdrops are being automatically tracked by CoinTracker, so at least you get an alert at the time it hits your wallet. So yeah.
So speaking just about like the taxable event situation, well, one, let's just go back to 2017. So the BCH fork that a lot of people like got, is there a way to like go back and amend that tax? Like, should we be doing that? Should we, like, what's the status?
Yeah, I mean, yeah.
Because, you know, tax law was super different then, I feel like, or the tax landscape was super different. So do amend those things?
IRS has not been super clear about what people should do. Just to make the thing even more interesting, in 2017, IRS didn't have any guidance on hard forks. And IRS first came up with that hard fork guidance in 2019, which is like, you know, 2.5 years after people filed taxes for 2017. So to this date, IRS hasn't said anybody, okay, you guys are required to go amend the return because this is how we believe, you know, hard fork should be taxed. So the whether to amend it or not, it just depends on the facts and circumstances of each case. Like if you ask me, again, not tax advice, again, because everything depends on facts and circumstances. If you got like a $200, you know, Bitcoin cash, like I wouldn't go and amend your whole return. But the answer for that question changes if somebody says, okay, I got 20 million in Bitcoin cash. So in that case, it's better for that person to go amend it versus playing the cat and mouse game, you know, just, you know, so the IRS can come after you or not. So the answer to that depends on each case.
So then, I mean, like, are there like ongoing discussions about revising taxable events in crypto overall? I mean, like, particularly as it relates to like spending it, but just the change of taxable events, like in general.
Yeah, when it comes to spending, I think last year there was a bill that was being introduced to the Congress to exclude, you know, transaction less than 600 from taxes, because if somebody's paying, you know, for a cup of coffee and using Bitcoin under that, you know, new bill, that should not be taxed. I don't know the status of that bill because after that bill was introduced, we had COVID and there was an administration, you know, that was being changed. So in 2021, probably late 2021, we might see something coming out of that. But yes, there have been discussions about introducing like a limit. So if you do transaction below that limit, that doesn't create a taxable event.
Okay. And so I understand that, you know, spending is obviously between wallets of you and, you know, a vendor or something. But what about when there's like multiple wallets that you're like moving between? Like, are those different events too? Like, are those also taxable events? If you're like, maybe it's like a spouse and you guys are filing together, or it's yourself and you're just like, you know, you have 1,000 like different wallets around, like what's the guidance on those things?
Yeah, so in that case, IRS has been pretty clear. If you're moving funds from one wallet to another or one exchange to another that belong to you, that's not a taxable event because you're not disposing of that asset, you are just transferring. But the important thing here is that you just had to make sure that you track the basis, because if you don't track the basis, in other words, how much you paid for the coin, it's really hard for you to calculate your correct capital gains amount after you transfer a coin to another wallet.
Yeah, because the new wallet doesn't know what the original cost basis was.
Exactly.
Cool. And then just to clarify again, back on the airdrops, I had another question come in. So are those tax or capital gains in taxable income in the year that they were received?
It's not capital gains. It's in the year that the airdrop is received, the income is taxed as ordinary income, just like your W-2 income.
Yeah. Okay. And so I know that, you know, the American government is always behind on things. Is there any kind of guidance out there about like DeFi and what's going on right now, or even like the NFT ecosystem, or just are we still just kind of working on what to do with Bitcoin and smart contracts and stuff?
Good question. Yeah, I mean, the IRS primarily, they're still trying to figure out, you know, Bitcoins and then stable coins, you know, just like, you know, very generic, you know, trades and sales and stuff like that. And when it comes to DeFi, like they haven't issued any DeFi specific guidance, but there's so many case laws and other tax codes that we can look at when it comes to how taxes should work on DeFi transactions. Because essentially DeFi is like, you have multiple transactions. You're earning interest, you're lending, you're borrowing money, you're receiving collateral, your collateral is getting liquidated. So I don't think IRS is going to issue any DeFi specific guidance. If you talk to a qualified, CPA who understand tax law and also crypto, they will tell you the tax implications of those DeFi transactions. When it comes to NFTs, it's the same thing. Again, IRS, I don't think they're going to come up with NFT specific transactions, but essentially NFT is a property. Say that, let's take an example. People are, the NFT that got sold was 69 million. So for the buyer, 70 million is the cost base. Then let's say after 5 years, he's selling it for 100 million. So he would have to pay capital gain taxes on 40 million. So yeah.
Yeah. No, gosh. No, cool. And then, so if we talk about like kind of about DeFi a little bit, but what about interest as it relates to staking? Is that actual income? Or how do we report those things?
Yeah, again, IRS has not said anything specific to staking, but they have said they have issued guidance related to mining income. I know that technically speaking, staking and proof of work mining are two fundamentally different things. But because we don't have any staking specific tax guidance, it's likely that IRS is going to treat staking income as income at the time you receive it. So it's going to be hard for you to track that staking income, because if you're staking something like Tezos, like every minute or every hour you're getting those rewards, and every time you receive those rewards have a different value. So you got to sum it up, and you would report the annual income, and that's going to get taxed at your ordinary income. So yeah.
I have a question. So as it relates to like staking or like in mining, et cetera, et cetera. And I know this is not like financial advice per se, but do you think that people should explore like opening up like like an LLC or an S corp or something to kind of house those operations for their like tax filings versus just filing as an individual who's like accumulating like $1 million in like rewards a year? You know what I mean?
Yeah. I see this question on Twitter all the time. I think there's a lot of big misconception around, I guess, about everybody that when you have an LLC or a corporation, that's automatically going to save you a bunch of taxes. That's not the case, especially if you're a crypto trader. If you do trade inside the LLC, that gives you additional legal protection for your assets inside the LLC. But all that LLC income is going to get taxed at your personal rate, because LLC is a pass-through entity. So there won't be any additional, tax savings coming out for somebody who's opening an LLC for crypto trading purposes.
Yeah. Okay. So what you're saying is I need to incorporate in Singapore. Okay, that's fine. No, I'm kidding. Cool. Are there any more questions that Shahan would be thrilled to answer? Otherwise, we'll give him just 1 minute to type, just in case. Yeah, that's what do you kind of foresee happening over the next like 2 to 3 years in like the tax space as it relates to digital assets?
I think IRS is putting so much resources into trying to catch these tax evaders. Several months ago, they captured John McAfee, who didn't pay, I guess, millions of taxes related to crypto. I think when I look at from IRS point of view, this is an area where that they see a lot of non-compliance, because a lot of people are either uneducated about crypto taxes, or they falsely think that, okay, I'm in crypto, IRS does not know about my taxes and they don't pay taxes. So this is a good area for the IRS for come and collect that tax revenue, because at the end of the day, IRS is in the business of collecting tax revenue. So my hunch is that they're gonna work with these third-party providers, software tools and etc. to kind of capture these people who are not paying taxes, if you have any profits.
Cool. So what about if we are operating like cryptocurrency accounts that are outside of the United States, how do we apply like those tax systems?
Yeah, so if, say, for example, you're using Binance.com or some other overseas exchange, but if you are a US resident, that's going to get taxed in the US. Yeah, that's a short answer. So just because you use an overseas exchange doesn't mean that that income is excluded from your US taxes.
Fair. Okay, well, I think we can wrap up. I don't have any more questions for you. For everyone that is still with us, feel free to definitely tag us on Twitter at @BitFlyerUSA, and say if you like the presentation, and we'll make sure to edit it and upload it to YouTube and send it out to an email list, et cetera, et cetera. So just give us some time to get it together. But it will make the slides available as well as the presentation itself with all the links that are highlighted here, right? And I think, do you have another slide, Shahan?
Yeah, I just want to, just a final remarks. I want to say thank you for Al and the entire BitFly team and everybody who attended. There's other resources, like in case if you need like some guides, we have the crypto tax guide, which explains everything that we discuss in very simple to understand terms. And if you're joining us from Australia, Canada, UK, we have those guides as well. And then the margin trading guide and also crypto tax letter guide. So these are free to use. And yeah, hopefully you'll find it resourceful.
Fair. Well, Shan, we will let you go. I'm sure you'll be hearing from me soon. And otherwise, thank you so much for taking the time, and take care.
All right. Thank you.